As a fractional CFO, I look at a lot of balance sheets. So I look at business balance sheets every week for new businesses. And one thing that I am seeing as a continued trend is that I am seeing more and more business debt. Businesses are coming to us with more debt on their balance sheets than I've seen in the past. And I'm starting to see this trend and with the businesses that we're talking to. So I'm thinking if we're seeing it with just a selection of small businesses, my assumption is a lot of small businesses out there are struggling with the same thing. So if you are in a situation with your business that you've got some debt that you would like to reduce, this video is going to be for you. Whether you have a small amount of credit card debt or you have maybe a big line of credit that you've used and you haven't been able to pay it off, or maybe you have an EIDL loan that you have sitting on your balance sheet and you know that it has a 30-year term on it, it doesn't really matter. All these things are considered debt, and this video will be helpful if you're trying to reduce that amount of debt that you carry on your business balance sheet. But before we go any further, I just wanted to say hi. My name is Hannah Smolinski. I am a CPA and I am a fractional CFO, and I own a fractional CFO agency called Clara CFO Group. And we, again, look at businesses all day long. We help people strategize about their business balance sheets and how to get out of debt. So that's why I'm bringing this video to you. If you are new to the channel and you've never watched any of these videos before, this channel is all about helping small business owners with managing and understanding their business finances. So if you find yourself in a situation where things are not very clear around your business money, you are in the right place. And so please check out our other videos as well. And you're welcome here. And please subscribe because we do a weekly video here. Okay, so the first thing I want to tell you guys is that it's okay. It is okay if you have some business debt. I am not going to be one of those financial gurus who's going to sit up here and shame you for taking out a business loan when your business was failing during the pandemic. Okay? No, I don't. That's not going to be me. I also even leveraged an EIDL loan during the pandemic. So I have a line of credit that I have in case I need to use it. I don't currently have a balance on it, but I leverage credit cards. I've gotten an EIDL loan. I'm a person that believes that debt can be used as a very strategic tool in your toolbox for your business finances. So I am not going to sit here and tell you that you shouldn't have any debt whatsoever in your business. However, I do think that there are some of us that have gotten to a place where we are continuing to take on more and more debt, and it's really burdening the business. And I don't want that. And I also see sometimes where people are starting to rely on just the fact that they can think they can get more and more and more credit, and they're getting themselves into bigger debt balances. And that is something that really concerns me. And I don't see that as using debt as a tool. I see that as more using debt as a crutch. And I don't want you guys to be doing that. Now, what we've done in the past is done. We can't go back and change any of our decisions that we've made in the past on our business. So now what I want you guys to do, and what this video is going to be about, is what are the strategies to deal with the debt that you currently have? Okay, because we can't go and change the past, and we can have a huge conversation, and we'll have other videos about whether or not, and we do already have videos about whether to take out a bank loan or a line of credit and ways to think about debt in different ways. However, what's done is done. We have some debt on the balance sheet at this point, so let's talk about what we can do to reduce it. And the reason that reducing debt makes sense and why we would even care is because when we carry debt, we usually also carry interest, and we have to pay interest on that debt. People aren't giving us money for free. So what interest is really just money going straight out the door to really do nothing for you. And so when we're thinking about running a business that's going to be financially efficient and profitable, when I see businesses that are paying tons of money in interest, it usually means that they're not able to hit their profitability targets in a lot of ways. So it can be a little bit self-perpetuating as well. The more debt you have, the more of your money is going to that debt, and then you're really not able to get ahead. So I don't love to see businesses taking on too much debt for the size of their business, and you can look at different ratios to determine how much is too much, but again, this video is really focused on strategies. So let's go ahead and get into the strategies of how to reduce debt in your business. And the first thing I want to say is that there are no silver bullets here. I'm not going to sugarcoat this. Any kind of debt reduction is going to take strategy, it's going to take planning, and it's going to take work. So there's not a one-size-fits-all easy button to get you out of debt. All right. Now, if there's going to be a one-size-fits-all thing that would help, it's to make more profit in your business, but that's not exactly an overnight answer to anything. So we'll talk about profit in just a minute. Okay. So the first thing you need to do if you are looking to reduce debt in your business is to find out how much debt you have. That is number one. You need to start from a good point of understanding all of your loans, every debt that you have outstanding. So you need to go through and list your credit cards, your bank loans, your equipment loans, your car loans. If you have any, long outstanding accounts receivable to vendors where maybe you owe them from something a long time ago and you haven't paid them, that would be considered debt. I mean, if it's short term, that's also debt, but this video is really focused on that long-term debt that you really need to pay off. So think about anything that you owe. This could even be owing the IRS. Do you have some outstanding tax payments? That is absolutely a true debt. All of these things are considered debt. Now, I want you to create an Excel spreadsheet or some kind of list, Google Sheet, whatever you like to use. And I want you to list out who the loan is for, like who's it with. I want you to list out the amount outstanding. You want to get your most recent statement so you can see your total outstanding balance. Because if you haven't looked at it in a while, it's probably gone up because of interest if you haven't made any payments. I want you to list the interest rate, what you're getting charged. And then the term of the loan. If it's a credit card, that's going to be, just due immediately. If it is a longer term loan, like an equipment loan, or if it's a car loan or something like that, or even a bank loan, a traditional term bank loan, you're going to have a term, maybe it's 5 years, 7 years, something like that. I also want you to put on there the minimum payment amount, and then I want you to put the payment cadence. So some loans might be a weekly payment cadence and some might be monthly. Most are going to be monthly. And then you might have maybe an annual requirement to make a payment on an annual basis, kind of depending on what the loan is. Most are going to have some kind of monthly payment. Okay, so that's going to be the standard and what is expected, but you might not have that. Now, a line of credit, like something like that, you might have your interest due every single month, but you don't have to make principal payments until whenever you can. So just look and understand what type of loan you have as well, and feel free to put that on that same list. Is it a credit card? You might have a credit card and a bank loan at the same bank, so make sure that you differentiate which one is which, okay? The next thing I want you to do is make sure your balance sheet is correct. Your business balance sheet, I want that to be correct with what you actually owe. So if you haven't informed your bookkeeper about maybe a side credit card you opened up to cover some expenses, that needs to get into your books, okay? So make sure that whatever you have identified as outstanding, that is on your balance sheet. So if you are doing the bookkeeping or somebody else is doing the bookkeeping, you need to put those loans into the books, into your QuickBooks or whatever accounting system you're using. The next thing that you can do to help you figure out what to do next is to rank your loans, and this would be on your Excel spreadsheet, in the priority that you want to pay them off. So I recommend looking at interest rate first to see which ones have the highest interest rate and start to put those at a higher priority. Now, if you have some type of loan that maybe has some other kind of term or stipulation that you need to pay attention to, this might also be a time to raise the priority. So let's say your key vendor, you owe them $50,000 and they will not give you any more product until you pay off them as a vendor. That might become a very high priority, even though the interest rate might be lower than your credit card. It might mean that if you don't pay that debt, it will affect the continuity of your business or the ability for you to actually go out and serve customers. If that's the case, you want to use that when you're considering and ranking your debts in priority. Now, you might also have something like a bank covenant, or your bank is requiring a certain payment within a certain amount of time. And if that's the case, you might need to also raise that in priority over just an interest rate. Now, if we are just looking at, there's nothing like that, we don't have any other kind of qualitative information that's going to affect the priority of our loan repayments, then we go by interest rate, okay? So I really like the idea of paying off the highest interest rate first for very obvious reasons, that the higher the interest rate, the more you're going to be paying in interest. And as soon as you can pay that off, that frees up more cash to go to principal payments, okay? So And when we say principal payments, that's paying off the actual amount that you originally borrowed rather than just the interest that's getting charged on it, because interest is really not doing anything for us besides just when we pay it off, it's just not building up. So it's like really, it's one of the most frustrating things to spend money on, in my opinion, is spending money on interest. So the next thing, now that you know kind of the game plan on what you want to do, and that shouldn't take very long to find all of your debt and know which priority, what things you want to prioritize, that shouldn't take very long. So the next thing you need to work on is increasing your profits immediately. Okay. The number one tool you have in your business, and I mentioned it briefly earlier, the number one tool you have in your business to pay off debt is going to be generating profit. When you have profit in your business, which just as a brief reminder, revenue minus your business expenses equals your profit. And that cash profit, if you're a cash basis, that cash can be used to pay off loans. Okay. When you are using those profits for other things, like you are taking them home as distributions, or you are, paying your taxes, which you still have to pay your taxes, or you still have to reserve money for taxes. So do not neglect that. Profit has to do a lot of jobs for you. And I can link above the profit video that we talked about what does profit need to do for you in your business. So if you're a little bit unclear on why profit matters when we're talking about debt, I will refresh you guys and put the video up here so you can check that out. But when we have profit, then we have more excess to be able to do something with, and that would be to be able to pay off debt. Okay. So how do we create more profit? We increase revenue or we reduce expenses. The easiest thing for you to do is look for places to cut expenses ASAP. Okay. Now it's going to be easier for you to just say no or to delay expenses than it is going to be for you to all of a sudden generate a lot more revenue. Because if the lever had been that easy before, you would have already pulled it. So obviously bringing in more money is a good solution. And we want you guys to think about what else you can do to increase your revenue. But the most immediate thing you can do is look through all of your expenses and just say, how can I reduce? Okay. Now, you might want to go through what we would call temporary austerity measures. I talk about austerity measures sometimes where it's just a brief time where we just don't do anything extra. Maybe it's no extra travel, no extra food in the office, no extra office supplies, nothing extra that is beyond the requirements of just how can we do business at a bare minimum. So if you are in a really, tough spot and you really need to make some big progress on your debt, I think that looking at how can you really reduce expenses makes a lot of sense. Now, also to increase profit, the best thing to do is also to look at how can I increase revenue? Can I increase my prices without reducing my volume? Can I add some additional services? Can I rent something out that I own? Do I have an extra office space? Like I actually have an extra desk over here. And I'm not in my office every day. Could I potentially rent that out if I really needed to? Probably. It wouldn't be a ton of money, but I could probably do it. What other things could you be doing to bring in excess money into the business? Think creatively here. And some stuff that's not going to take a lot of additional expense to get it up and running. That's why increasing prices is like the number one thing. Is there something that we can just charge a little more for? Is there some way we can add an additional service fee to our invoices? Is there some way that we can just, do a little upcharge here or there for like an additional service? Is there something that we can do to add more value to our clients or our customers, which therefore they'd be happily willing to pay for? So there are lots of, I can't give you all the examples of ways to increase your revenue, but we do have some videos on revenue as well. We'll try to link those in the description box below. And really it's about how do we increase profit? Because when we have more profit flowing through the business, we will have more excess to then go and pay off debt. And it's very important when you are generating profit that you're still saving for your taxes and you are not being like, hey, we got so much extra profit, now I'll take big owner's distributions, because that's money that needs to go to paying off debt. Okay, so when you have the profit, don't get too excited because you've got work to do with that and paying off debt. Okay. So the next strategy that I have for you guys is when you have your plan for your financials and that reduced expenses and the increased revenue, and then now you understand your payments, you need to create a cash flow forecast. So I have a free cash flow forecasting template for you guys, and a lot of you have already downloaded it, but if you haven't, we will make that available below. And then we have videos and resources around cash flow forecasting as well. Cash flow forecasting is going to be what's going to help you plan. I had mentioned planning earlier in the video. You will be able to plan for reducing your debt over time. So you can see, okay, I'm going to have some excess here. I'm going to put it to this debt, and then that one's going to be paid off, and then I can move to the next one. And you can see in the timeline of what is actually going to work for you and when you're actually going to get your debt paid off. And it's going to give you some motivation to be able to say, okay, maybe I want to work a little bit harder. Maybe I want to take on a little extra client. Maybe I want to do a little bit more in order to get to that goal faster. The cash flow forecast will help you there, just to be able to see it all and see the master plan. Quick story, I helped a client who had come in to work with us when they had about 3 years worth of IRS back payments to pay for lots of different reasons. There was basically a huge bill to the IRS, and worked with this client to be able to pay off 3 years of tax liability, including the current year, also making current year tax payments all within 1 year. And the main tool that we use to do that, well, is one, her incredible hustle. And she went and was able to do all sorts of things to make additional income. But with that, we use the cash flow forecast to be able to project out how much we would need to have and how much to cover normal operations of the business, plus then all the excess cash that was going out the door to pay off all of those back taxes. So it was an incredible effort on her part, which I'm just still super impressed by. And she was able to be very profitable that year in order to do that. But it was really like her hustle plus the cash flow forecasting that really made it all work. So cash flow forecasting will be your friend in this endeavor. So let's talk about some really practical things you can do to move your debt forward and to get it paid off. So one of the things that really gets people down is credit card debt, because credit cards can have 20 to 30%, even higher percent interest. And with that, it is incredible how fast your credit card balances can build up if you're not making really significant payments on them. So one thing that I like to see for clients, and we do this with clients, is that when we have really significant debt balances on credit cards, we look for a 0% balance transfer as soon as we possibly can. So if you can move that credit card balance to a different credit card balance, a lot of times they have these introductory 0% transfer your balance and have 0% for a year, maybe it's 18 months, maybe it's 6 months. You can look and shop around for who has the best balance transfer deals, but you could essentially take, maybe $20,000 that's at 25% and move it to $25,000 at 0% for a year. So if you can make that kind of move, then all those payments you're making towards that credit card immediately become much more powerful because you're not paying that high interest rate on it. Now, what people might do, and this is the thing you got to watch out for, is you move that credit card to 0% and then you think, oh, well, now it's 0%. Now I don't have to pay it off. Don't think that way, because you will have to pay it off in that year time frame. And then sometimes there can be some penalties around that as well, or maybe even some back interest. So you want to pay it off still in that term where you can really take advantage of that 0% interest. So you don't want to have it sitting there and then you're back at square one, or maybe even worse, a year later. So if you're going to do a balance transfer, you need to take advantage of the 0% and really make some progress at that point in time. So another strategy that I have for you, and this might be a little bit obvious, but it's to look around to see if you have anything you can sell to generate cash to pay off a loan. So this might mean if you have a vehicle that's not being used, is there a way that you can sell it in order to help pay off the loan? Or if you have a piece of equipment that you're no longer using that's not helping your business, can you sell it? So this can also apply to if you have anything at home. So if you have anything at home that you could potentially sell and invest it into your business, that is also an option. But what you would do in that situation, or if you just have cash at home that you want to infuse into your business and then pay off the debt, you can record record that as an owner's contribution. You don't want to just make it a loan back to yourself, because then you're just kind of like refinancing your own loan, but you would make it an owner's contribution into the business that would go into the equity section of your balance sheet. Maybe you got an inheritance in your personal life and you decided that you wanted to actually use some of that money to pay off some of your business debt. If that's the case, you would take some of that money, transfer it over into your business, record it as an owner's contribution, and then you would pay off your business debt with that cash. Or maybe you had an asset in your personal life. Maybe you had a snowmobile and you sold it for $5,000 and you said, hey, the best way to put this money to work is to actually put it into my business. You would do the same thing. Take that $5,000, put it as an owner's contribution into your business, and pay off the debt that way. Okay. So you can fund your business if you need to in order to pay off debt. Okay, so another strategy that I have for you, and I'm sure you guys have always heard of this before, is to consolidate your loans into a lower interest loan. So you have probably heard of consolidation in student loans before, where you take like multiple student loans and you combine them into one bigger loan that would have potentially a lower interest rate. Now, you can do this for business debt as well. The thing here is to find a good new loan that you would be able to get it and get that money to pay off the other items. Now, banks don't love when you approach them and you say, hey, I want more money so I can go and pay off other debts. They don't typically love giving money for that. Now, sometimes you can go get a loan for $20,000 to $50,000 fairly easily from a bank. And if that's the case and they give you the money, they're not really asking questions about what you're doing with it. So maybe you're paying off a $5,000 credit card and a $10,000 credit card and a $30,000 or a $25,000 equipment loan. Like that might make sense that you go and use the money to go and do that. And then you would have one bank loan rather than these multiple loans at potentially higher interest rates. Typically, credit cards are going to be higher interest rates, and sometimes like auto loans can be quite high and equipment loans can be quite high as well. So again, look at your interest rates and decide what makes sense, and then look to see if the new loan is going to be lower overall for you. Now, when you're getting that new loan, make sure you're making sure that you can pay off the loan in the term. So if you don't get a 2-year loan, if those payments are going to be too aggressive for you, maybe you need to make that loan a 5-year loan or a 7-year loan in order for you to make the payments. So, think about that if you are going to consolidate the loans. I would recommend probably going to your bank first for this. There are lots of online lenders, and you can go and look into those, but just read all the fine print, talk to other people who've used any online lenders, and be very, very, very careful, because there are a lot of predatory loans out there that you could be getting yourself into a worse situation rather than improving your situation. Okay. So be very careful when consolidating, because sometimes it can sound all nice and great, but then at the end of the day, you could be getting yourself into a worse situation. So make sure you're really understanding what you sign on to before you move into a consolidation. Another strategy that I've used with a client before is to take a line of credit and turn it into a bank term loan. So lines of credit are typically some of our lower interest rates, which is great. But the thing about a line of credit is that a bank at any point in time can call your line of credit. Now, this doesn't happen very often, but typically lines of credit for businesses should be used and paid off and used and paid off. And a bank likes to see that you're letting your line of credit rest. And so if you're getting in a situation and resting for the line of credit means that you are not using it, so that you fully paid it back and you're not using your line of credit at all. Banks like to see that. They think that's healthy. So if you're in a situation where you've drawn out all the money on your line of credit and then you are not able to pay it off because you're in other debt and you're not able to do that, that can be a really scary situation for a business owner that then needs to go and come up with $100,000 to pay off their line of credit all of a sudden if the bank were to call that. So what we have done before is to take a line of credit and then turn it into a bank loan with the same bank. So basically they can transfer it into a term loan which would then give you a payment amount over a certain term at a set interest rate. So that would free up your line of credit. They might close your line of credit and say, hey, you don't get this anymore, but it would at least reduce the risk of having that $100,000 line of credit called all at one time. Okay. So you might want to look at that. Talk to your banker if you think that might make sense. And if you aren't able to pay off your line of credit, it might need to be a term loan instead of a line of credit. You can potentially try to refinance your business loan. So refinance an auto loan, a equipment loan, just a standard bank loan. If you refinance a loan, it could potentially affect your business credit or potentially even your personal credit, depending on how the loan was actually taken out. So I say refinance, but with an asterisk of, understand exactly what you're going to do before you get into a refinance situation, and understand if it's going to really help you and whether or not it could be a negative ding on your credit score. One of the best things you can do to help reduce your debt is to not get into new debt either. So yes, I've already talked about reducing our spending and increasing our revenue, which hopefully gives us more cash flow, which should help us not get into further debt. But do not get yourself into further debt by also paying late and getting penalties. So if you are not making your minimum payments because you're putting money elsewhere, but then you're generating penalties on top of the fees that because you're not making your payments, that is going to increase your overall debt. And so we do not want that. Make sure that you are paying everything on time and use auto pay where possible, especially when you just have those minimum payments going out for anything that you're not really tackling head on and you're just paying minimum payments. Set those to pay automatically. Do not get any additional dings and additional balances added to your already outstanding balance because you're getting those late fees, okay? And the last thing I want to mention here is just really the mindset of reducing debt. It can sometimes feel overwhelming when you have a lot of debt, and it can start to feel like you might never dig yourself out of it. But what I want to focus you guys on is that reducing debt is a process, but it's also a process that will help you be more healthy in the long run. It will also help your financials look more attractive if you are going out and, looking to sell your business one day, or you're looking to get another loan, or you're looking to maybe make a purchase of another business. All of those things would be good for a bank to look at and understand that your balance sheet is healthier. So when we reduce our debt, it does make our balance sheet look healthier. And I think all of us would like to know that our balance sheet is healthy and that our business is healthy. So remember that health in the business is like health in our bodies. This doesn't happen overnight. Work at it, stay consistent, just like you would with an exercise program or eating healthy. Taking care of your debt is going to be really the same way. So be consistent, be dedicated to it, and you will make significant progress to reduce the debt in your business. All right. If you guys have any other questions, please put them in the comment section below. I am here to help you. I am, again, a fractional CFO who sees this all day, every day. And I'd love to be able to help you in reducing the debt in your business. All right. Also, be sure to check out the resources of the other videos I mentioned in the description box below, and we will see you next time. All right. Thanks, everybody.